today's report, the 5th of July. Nice for the week. Today, I would like to share with you an indicator used by Warren Buffett, and it was popularized by him. Now it's named after him. It's known as the Buffett Indicator, and currently the indicator is flashing danger. So I want to discuss about this, so everybody has a better idea what it is all about and what does it mean. Okay. So the Buffett indicator is a simple ratio used to determine whether the stock market is overvalued or undervalued. It is calculated by dividing the total market capitalization of a country's stock. That means all the stocks together, what is its value? What is its value? And then by the gross domestic product of that country. So what's the GDP of the country? So you divide them, you get the Buffett indicator to know whether it's overvalued and undervalued. For a more detailed analysis to determine the values, analysts collect historical data on the market capitalization to GDP ratio over a significant period. Now, this helps a baseline or average value for the indicator. Now, why they want to use GDP? Because GDP is the total monetary or market value of all finished goods and services produced in that country at a specific time, right? So when you divide that, you can actually know the whole market, your country and your stocks, what is ratio like. So when you get this historical average, you roughly will know, okay, what is the current condition of your country overall, right? Now, so from this historical data, experts calculate the mean, or what you call the average, and standard deviation. Okay, the standard deviation measures how much variation or dispersion dispersion here means the areas that exist from the average. So from there, you have a clearer idea where we are already. Now, the current market cap to GDP ratio is compared to this historical mean. If the ratio significantly exceeds the mean, it may be considered overvalued. So to give you a clearer idea, if the current ratio is one standard deviation above the mean, like 100% above the mean, the market is often considered slightly overvalued. Now, if it's like 2 or more standard deviation above the mean, it's typically considered significantly overvalued. So I'm going to show you a chart, then you have a clearer idea. Now, this is the chart, right? Shown over here, picked up from here. Now, this is the current data. And what you can see, the Buffett indicator is right now showing that the price is very near the, it crossed there temporarily, but right now it's trading back again. Okay, so we are at a point where the market is significantly overvalued. Now, despite this, there's no definite statistical metric to forecast the duration for which stock valuations might remain elevated before a potential correction or reversal. Just to let you know that the market is significantly overvalued at the current moment. Now, historically, markets have sustained high valuations for prolonged periods, often influenced by factors such as robust economic growth. Okay, where that we have experienced that, in the US, and said everything looks fine and dandy. Jobs is still good. There are situations where you have the low interest rates, but now we don't have that. If they start cutting, they may think that, yeah, we move into that area. But there are certain things like this market stimulating policies that as well can help sustain the high valuations. But we are not in that situation at the current moment, because we don't have the low interest rates or any market stimulating policies at the current moment. Just economic growth, but that has shown some you know, some cracks lately as well. Now, one thing is for sure, it is particularly concerning to note that historical patterns where spikes in the indicator have preceded almost every US recession, regardless of scale. So we are seeing that spike right now. So there is the possibility of a market correction. Now, currently, the valuation to GDP ratio stands at 197%, not reaching the peak of 217 seen in 2020, but still substantially higher than levels observed prior to dot-com bust and the onset of the subprime crisis in 2007. So year 2000, 2007, basically 197, where you've seen in the chart earlier, we are there right now. It's already higher than that already. Okay, so additionally, the market shows a worrying trend of increasingly concentrated gains. Presently, the top 10 firms represent 77% of the S&P 500. Now, this concentration of market power mirrors troubling similarities to conditions of 1929 as well. So, what does all of this mean? At the end of the day, although the Buffett indicator is not an infallible predictor of market crashes, its current high level, well above the generally accepted threshold of 100% for a fairly priced market, should prompt caution among investors. So this is what I want to say only. So if you're planning like to keep on buying, I think you have to be very careful because due to the market valuations already. Okay. So now, having said that, like I said already in my previous reports, during election years, right, the market tend to be strong, rally, to give the idea that everything is fine and dandy. But right after the elections, things can change rapidly. So you have to be careful and understand all these developments. Okay. Right. That's the end of the report for today. Let's move on to the charts.